Morning, everybody, and welcome to our release of third quarter 2022 performance results for FDIC insured institutions. The banking industry reported continued positive results this quarter amidst persistent economic uncertainty. Net interest income grew, loan growth continued, and asset quality measures remained favorable. The banking industry reported an increase in quarterly net income from last quarter and 1 year ago, primarily due to improved net interest income. This more than offset an increase in provision expenses. That's the amount set aside by institutions to protect against future credit losses. Net income also increased from last quarter and year over year at community banks. Higher net interest income more than offset increases in non-interest expense and declines in non-interest income from lower net gains on loan sales. Rising market interest rates and strong loan growth supported a substantial increase in the net interest margin from the second quarter. Most banks reported higher net interest income compared with last quarter. However, additional interest rate increases combined with longer asset maturities may present challenges for the banking industry in coming quarters. Unrealized losses on available for sale and held to maturity securities totaled $690 billion. That's up 47% from the second quarter of this year. The deposit insurance fund balance was $125.5 billion on September 30th. That's up $1 billion from the end of the second quarter. The reserve ratio was unchanged at 1.26% as insured deposits grew 0.1%. Despite several favorable performance metrics in the third quarter, the banking industry continues to face significant downside risks. These risks include the effects of inflation, rising market interest rates, and continued geopolitical uncertainty. Taken together, these risks may reduce profitability, weaken credit quality and capital, and limit loan growth in coming quarters. Further, higher market interest rates have led to continued growth in unrealized losses in the banking industry securities portfolios, as I indicated, and higher market interest rates may also erode real estate and other asset values, as well as hamper borrowers' loan repayment ability. These will all be matters of ongoing supervisory attention by the FDIC. Now let me walk through some of this in greater detail. As shown in this first chart, the banking industry reported net income of $71.7 billion in the third quarter. That's up $7.3 billion, or over 11% from the prior quarter, and up $2.2 billion, or over 3% from the third quarter of last year. Strong growth in interest income outpaced growth in interest expense, pushing net interest income up 11.6% quarter over quarter. The growth in net interest income outpaced the increase in provision expense from the prior quarter. At some point, we would expect the gap between interest income and expenses to narrow as market forces place pressure on banks to raise deposit rates faster than they have to date. The banking industry reported that the cost of deposits increased by 34 basis points in the third quarter, while yields on loans rose 65 basis points. Compared with the industry as a whole, community banks reported a stronger increase in net income from the year-ago quarter. Net income for community banks increased $1 billion, or 13.5%, from 1 quarter ago. Now, in this second chart, it shows that quarterly net operating revenue increased 7.6% from the second quarter of 2022. That's up to over $245 billion. Net interest income as a percentage of average assets increased from the second quarter, but still remains slightly below the pre-pandemic level, largely due to strong asset growth during the pandemic. Non-interest income as a percentage of average assets was relatively flat from the second quarter, as the growth in non-interest income kept pace with average asset growth. Now this next chart shows that the net interest margin for the 5 asset groups on which the QBP reports, it shows the net interest income on the 5 asset groups. The net interest margin for the banking industry as a whole widened significantly in the third quarter, increasing 35 basis points from the last quarter to 3.14%. This is the largest quarter-over-quarter increase recorded in the history of the QBP, and all QBP asset size groups reported quarterly net interest margin growth. Despite the improvement, the net interest margin for the banking industry as a whole still remains below the pre-pandemic average of 3.25%. The net interest margin for community banks also expanded, but by a smaller amount than the industry. The net interest margin of community banks widened 30 basis points from the last quarter to 3.63%. Now, this next chart shows that the banking industry's holdings of longer-term loans and securities remained elevated at 39.2% in the third quarter. Although this higher level of longer-term loans and securities helped preserve net interest margins during the period of lower interest rates, this strategy has contributed to the increase in the level of unrealized losses on investment securities as a result of higher rising interest rates. Compared with the industry, community banks continue to report a higher proportion of assets with maturities longer than 3 years, 54.4% of total assets for community banks. Now, this next chart shows the continued growth in unrealized losses on investment securities this quarter due to increases in market interest rates that I referred to earlier. Unrealized losses on available for sale and held to maturity securities totaled $690 billion. That's up 47% from the second quarter of 2022. The combination of a high level of longer-term asset maturities and a moderate decline in deposits underscores the risk that these unrealized losses could become actual losses should banks need to sell investments to meet liquidity needs. Now, this next chart shows that total loan balances grew for a 6th consecutive quarter. Loan growth for the industry exceeded the pre-pandemic average pace, even without adjusting for the reduction in Paycheck Protection Program loan balances. The banking industry reported growth in several loan portfolios from the year-ago quarter, led by commercial and industrial loans, 1 to 4 family residential mortgages, and consumer loans. Loan balances grew 9.9% from the previous year for the banking industry. That's the highest annual growth rate reported since the second quarter of 2006. Compared to the industry, community banks reported still stronger loan growth, increasing 12.2% year over year. Commercial real estate loan portfolios continue to drive annual loan growth for community banks. Paycheck Protection Program loan payoffs and forgiveness continue to affect loan growth rates. Excluding the effects of these PPP loan payoffs, the annual loan growth rate would have been 11.6% for the industry as a whole and 15.7% for community banks. Our next chart shows that asset quality ratios for the industry remained favorable. The non-current and net charge-off rates are only slightly above historical lows. The non-current rate declined 3 basis points from the second quarter to 0.72%, driven by reductions in non-current 1 to 4 family residential real estate loan balances. Increases in consumer loan net charge-offs, namely auto loan and credit card net charge-offs, drove a 6 basis point increase in the industry's net charge-off rate from 1 year ago to 0.26%. Like net charge-offs, early delinquencies, that's for loans past due 30 to 89 days, increased slightly from the year-ago quarter, also driven by past due consumer loans in addition to commercial and industrial loans. These early delinquencies could be an indicator of future asset quality problems and will be an area of continued supervisory monitoring. Community banks reported stable or improving credit quality metrics. The community bank non-current rate declined 4 basis points from the previous quarter to 0.47%. That's the lowest level on the QBP record. The community bank net charge-off rate was unchanged from a year ago at 0.06%. But like the industry, early delinquencies for community banks increased from the year-ago quarter, driven by an increase in past due commercial and industrial and consumer loan balances. Now this next chart shows that non-current loan balances fell while the allowance for credit losses grew year over year, resulting in an improvement in the average reserve coverage ratio. The ratio of credit loss reserves to non-current loans increased from 180% 1 year ago to 214%. That's the highest level on QBP record. The next chart shows that the number and total of assets on banks, shows the number and total assets of banks on the problem bank list. The number of banks on the list increased by 2 from the previous quarter to 42 banks. However, total assets held by problem banks declined $5.7 billion to $163 billion in the third quarter. The number of problem banks remains near record low levels, and no banks failed in the third quarter. This next chart shows that deposits declined for a second consecutive quarter. A reduction in uninsured deposits was the primary driver of the quarterly decline, while there was actually a small increase in insured deposits. Uninsured deposits have now declined for 3 straight quarters. Deposits totaled $19.4 trillion. That's down 1.1% from the level reported in the second quarter. While this reduction slightly offsets the unprecedented growth in deposits reported during the pandemic, total deposits are still well above pre-pandemic levels. Now, this next chart shows that the deposit insurance fund balance was $125.5 billion on September 30th. That's up about $1 billion in the second quarter. Assessment revenue was the primary driver of the increase in the fund, offset partially by unrealized losses on available for sale securities in the deposit insurance fund portfolio that were driven by the rising interest rate environment. Insured deposits increased by 0.1% during the third quarter. Year-over-year insured deposit growth was 3.4%. These factors caused the reserve ratio for the fund, that's the fund balance relative to all insured deposits, to remain unchanged at 1.26% as of September 30th when compared to last quarter. This is 1 basis point lower than a year ago when the reserve ratio was 1.27%. The FDIC adopted a deposit insurance fund restoration plan on September 15, 2020, that was intended to return the reserve ratio to 1.35%, the statutory minimum, by September 2028 as required by law. However, as of September 30th, 2022, The FDIC projected that the reserve ratio was still at risk of not reaching the 1.35% by the statutory deadline. Therefore, in October, the FDIC board finalized a rule to increase initial base deposit insurance assessment rates by 2 basis points beginning in the first quarterly assessment period of 2023. These actions were undertaken to improve the likelihood that the reserve ratio reaches the statutory minimum of 1.35% before the statutory deadline, while reducing the potential for a pro-cyclical increase in assessment rates should the banking industry enter a period of stress in the interim. In conclusion, overall, as I've indicated, key banking industry metrics remain favorable at this time. Loan growth continued, net interest income grew, and asset quality measures remained favorable despite a rise in early delinquencies. Further, the industry remains well capitalized and highly liquid. However, the banking industry continues to face downside risks resulting from economic uncertainties, inflationary pressures, rising interest rates, and geopolitical concerns. These factors could hamper bank profitability, weaken credit quality and capital, and limit loan growth. And these risks will all be matters of continued supervisory attention by the FDIC over the coming year. That concludes my prepared statement. I appreciate your attention, and I'll be happy to take your questions.
Thank you, Mr. Chairman. Again, we encourage reporters to turn on your camera during the question and answer session. If you have a question, please use the raise your hand feature and I will call on you by name. Claire Williams.
Hi, thank you for taking my question. My question is about the deposit insurance fund, which remained unchanged while the DIF increased $1 billion. Is that something that changes or reinforces your thinking on increasing assessment fees?
It certainly, I don't think it changes our perspective on this. Insured deposit growth increased marginally. The reserve ratio, as I indicated, remains at 1.26%. That's still well below the statutory minimum of 1.35%. It still raises significant uncertainty as to whether, we'd reach the 1.35% minimum within the required time period of September of 2028. So, in that regard, it indicates to us that the measure we took earlier in terms of bumping up deposit insurance assessment was still a prudent measure to have taken.
Yeah.
All right, next question would be from Carolina Mendel from Reuters. You're on mute, Carolina. You have no audio. Can you send me an email and I will, or put it in the chat function and we can read it for the chairman later? Carolina, yes. Thank you. Any other questions? Let's just.
Are we going to take non-QBP questions?
Yes, if you have some, we can take them, yes. Claire?
Great.
American Banker?
Watching the nomination hearing yesterday, assuming the slate of nominations, including yours, goes through, are there any particular areas of tension or agreement you foresee with your future potential Republican colleagues?
Well, I certainly hope the confirmation process works out. I know both of the other nominees. I have every reason to think that we'll be able to work together in a collegial way, and I really look forward to the opportunity to do that.
Any other questions? Allison Bennett?
Yes, hello. I do have a question about the unrealized losses that you have announced that they've nearly doubled, that there is, some thoughts about what might happen going forward. And I wonder if you could maybe address the question of, how likely is it that these loans that these losses will have to be realized, and just what the picture is going forward as far as the unrealized losses.
No, it's an important question to ask, and I mean the answer is that it's an underlying risk. It'll really depend, I think, on how the economy plays out going forward. As I indicated, Allison, right now the industry is well capitalized and has strong liquidity, and because of its current liquidity strength, it should have no necessity to sell those assets and take those unrealized losses. The issue will be how will things play out for the economy and the financial system going forward. If we have a changed set of circumstances and liquidity becomes tighter, and that's a question, but if it should occur, then the institutions could be under some pressure to meet liquidity needs by selling off some of those assets, and that could result in significant losses for institutions. So it's a risk that we thought is important to highlight and the industry to pay attention to as we move forward here.
Thank you.
Any other questions? All right, well, if not, please do reach out to, oh, I'm sorry, Claire, you have another question?
I'll hit you with one more. You noted yesterday that bank regulators' caution when it comes to crypto has helped insulate the banking system from volatility in the sector. But as we learn more about FTX, it's clear that maybe the connections are more than we first thought. I'm thinking specifically of Farmington State Bank. Do you anticipate any further spillover from FTX into the banking system? And do you think that the bankruptcy filings highlight any previously unforeseen blind spots in bank regulation?
I think we're looking closely, as you know, that with the Fed at the Farmington State case. I think there's a lot of review as well going on with FTX, so we'll learn more about the operations of that company and whether there might be any additional connections to the banking system. We're not aware of them now, but there's a careful review ongoing, so we'll see what it might reveal.
All right, with that, I think we'll call it a day. So thank you for joining us. If you have any follow-up, you can stay on the line and staff will be available to help you with some technical questions. And feel free to reach out to the FDIC's communications staff if you have questions later on in the day. Thank you.
Take care.
Thank you.
camera out. I can't hear.